As I teach people about maximizing returns and minimizing taxes, one of the things that I noticed is that once people learn about a Roth IRA, they want to go all in. So in this video, I'm going to walk you through the 5 most common Roth IRA mistakes and show you how you can legally avoid them. The Roth IRA is a great investment vehicle. If you do it right, you can have a fortune while only paying taxes on a little bit of it. And along the way, it gives you the ability to take out your own contributions at any time for anything. But as great as it does come with some restrictions. And if you're not careful, it can cost you thousands or even wipe out all of your growth. Mistake number 1 is thinking that if you make too much money, you can't have a Roth IRA. But really, you just don't know the right way to contribute. Let me explain. To open a Roth IRA, you find a brokerage firm that you like. It can be Vanguard or Fidelity or Charles Schwab. And at this point, the government is not involved. Your brokerage doesn't know and doesn't track your income. So even if you earn too much to contribute to a Roth IRA, they're not going to stop you from making a deposit. However, they are required to report your contributions to the IRS. And since the IRS does know your income, they'll catch any excess contributions. If you contribute more than allowed based on the income limits, the IRS will charge you a 6% penalty. And that penalty can quickly eat into your returns. For example, if your investments are earning 8% per year, you factor in 2% inflation and then a 6% penalty, and your real return drops to 0, essentially canceling out any growth. A lot of people will assume that if they make more than an annual income limit set by the IRS, they can't have a Roth IRA, but that's not true. The first legal option is to contribute to a traditional IRA instead of directly to a Roth IRA, since traditional IRAs have no income limits for contributions. You can set up automated contributions throughout the year, and then at the beginning of the following year, convert those contributions into a Roth IRA. This is the strategy that's called the backdoor Roth IRA. It might sound a little complicated at first, but remember, everything feels complicated when you do it for the first time. And once you've gone through the process for the first time, the next time is a lot more manageable. Now, if you're looking for a simpler option, you can contribute to a Roth 401k with your employer, which has no income limits like a Roth IRA does. In just a second, I'll break down the key differences between a Roth 401k and a Roth IRA so that you can decide which one works better for you. The next big mistake that people make is treating your Roth IRA like a savings account just because you have the ability to withdraw your contributions at any time. But if you look at the simple wealth formula, you'll see that growing wealth depends on 3 key factors. Time, that's starting as early as possible. Consistent returns, these come from investing in a broad market fund or a well-balanced portfolio to maintain that steady growth. And capital, these are your consistent contributions. If any of these are missing or too low, your wealth building potential takes a hit. So before withdrawing from your Roth IRA, consider the long-term impact. For example, let's say you've been contributing since the age of 18 and at 35, you take out a $50,000 lump sum for your home down payment. That might not be a bad move. It's a one-time withdrawal. You are reinvesting it in another appreciating asset, real estate, and it's less than 50% of your total contributions. You won't delay your first million by too much. Another reasonable case might be using your Roth IRA funds for education instead of taking on student loans. If you have a solid balance and you need $20,000 or $30,000, taking it out from your Roth IRA might make sense, especially if student loan interest rates are high. All right. The next mistake that many people make is not considering a Roth IRA because you have an employer plan, or thinking that a Roth IRA is the same as a Roth 401k. A lot of people will assume that if their employer offers a Roth 401k, they don't need a Roth IRA. Both of these plans have the same tax-free withdrawal benefit, but they have some key differences. The biggest difference is the one we talked about earlier. Roth IRA allows you to take out the money you put in anytime, while with the Roth 401k, you have to wait until you're 59 and a half. A Roth 401k typically has limited investment options compared to a Roth IRA. With an IRA, you have access to a wide range of low-cost index funds, ETFs, and individual stocks, which can help you maximize your returns. Another disadvantage of employer-sponsored plans is that they sometimes come with higher fees, which eat into your returns over time. Here's an example of how different fees affect your portfolio. The first column is the final amount you'll have in your account if you invested your $100,000 into Vanguard S&P 500 index with a 0.04% fee. The middle column represents the $100,000 if invested in a target retirement fund with a 0.08% fee. And the last column in the red is if you chose to invest it into an actively managed mutual fund with a 1% fee. Almost $250,000 difference, but if you're looking at performance, it's not any different than broad indexes. With a Roth IRA, the choice is yours. You can open one with Vanguard or Charles Schwab or Fidelity or any other credible investment institution. And if your employer is using some provider that doesn't have a nice and simple to use user interface or customer service, opening one on your own definitely lets you do that. So how do you pick the right account for yourself if you have access to an employer-sponsored fund? First, start by making sure that you contribute enough to get your employer match. That's free money. If you're in a low tax bracket, prioritize the Roth option to lock in today's lower tax rate. And if you're in a higher tax bracket, opt in for a traditional 401k or a traditional IRA so that you can defer taxes until later. If you need flexibility for house down payment or education, a Roth IRA can be a smart choice, and make sure to use the backdoor strategy if you're in a higher tax bracket. If you've done that and still have more money to invest, you can contribute more to your employer plan or go with an individual brokerage account. Okay, mistake number 4 that I see all the time is people getting so excited and think that they can get around the limit of $7,000 if they open up multiple IRA accounts and maximize each. But unfortunately, the contribution limit for Roth IRAs applies across all accounts combined, not per account. All brokerages will report your contributions to the IRS, and the IRS will issue a penalty for anything over the limit. When it comes to managing money, I prefer to make it as simple as possible, which means the fewer accounts, the better. Some people will open up multiple accounts if they want to have individual stocks in one and index funds in another. The firms I mentioned earlier, Vanguard and Charles Schwab and Fidelity, allow you to have both mutual funds and individual stocks in your portfolio. So there really isn't a need to have more than one. You'll only have one place to track your contributions, which makes it easier to monitor performance. Make sure that you're diversifying and not just stacking up different funds with the same holdings. Plus, with just one account, you're less likely to accidentally over-contribute or forget to account for contributions in multiple places. And the last mistake that I want to talk about is the one that goes beyond the Roth IRA and can cost you thousands of dollars or even wipe out all of your balance. It's not understanding what investing is and confusing it with speculation and gambling. A lot of people think that investing is buying and selling stocks, and while that's part of it, it's really just the tip of the iceberg. The real key to investing is picking solid companies with strong financials and long-term growth potential, and not just chasing the hype. You also don't want to put all your eggs in one basket. Spreading your money across different companies lowers your risk. And if you want to maximize your returns, you can look at industries that are growing and have the potential to outperform the broader market. On the other hand, speculation is completely different. It's not about a long-term growth, but instead it's about trying to profit from short-term price movements. Successful speculators rely on deep understanding of market trends, technical analysis, risk management, and discipline. They know how to assess momentum, control their downside, and execute trades with a clear strategy. The problem is that most people who buy and sell stocks don't actually do this. Instead of following a methodical approach, people just pick stocks or crypto or other assets they think will take off based on some hype, gut feelings, and what's trending. And this is straight up gambling. In the context of the wealth formula, this strategy lacks both the benefit of time and the benefit of steady returns. A friend of mine spent the last 4 years trying to turn their $50,000 into 100, jumping between Bitcoin, penny stocks, and large company investments. And no matter what they did, they couldn't make it grow. But if they had just put that $50,000 in the S&P 500 4 years ago, today they'd have $78,000, all without the stress and second guessing. Building a solid investment portfolio can feel overwhelming, and sometimes for all the good reasons and sometimes for all the wrong reasons. But the good news is you don't have to make it complicated. You can invest in broad market funds or choose a target retirement fund. Vanguard makes it super easy so you can focus on the rest of your life without the stress of financial decisions. All right, I hope you guys enjoyed this video. If you're new to investing and want to learn about my personal mistakes I made against my better judgment when I first started investing, check out this video. And if you want to learn more about a Roth IRA, check out this one over here. Thank you so much for watching. I'll see you next week.